Hi, everyone. My name is Jackson Pineau. I am Mars Public Affairs Manager, and I'm going to walk you through our residential market update for March 2024. We are going to start things off by just getting the overview of our agenda today. We like to start things with our monthly housing charts, get you that fun data everybody's looking for nice and early. We'll dive into some market segmentation after that, get into the weeds, and then wider housing market look at. First, we're going to look at the US housing market in general, and then we're going to just generally talk about the wider economy and how what's going on in the economy has an impact in our real estate market here. We always have time for questions afterwards. I want to save about 5-10 minutes or so for that. So please, I encourage the questions either in the chat, our Q&A button if you want to use that, and also for you YouTube viewers, if you want to put things in the comments, I look at them from time to time. By all means, throw a question in the comment and I might respond back to you. So let's kick things off with an inspirational quote. I actually really enjoy looking for these while I make the charts for you all. And this one is from Katarina Fake. She is an American entrepreneur and businesswoman. She co-founded the website Flickr in 2004, and she was the chairwoman of Etsy for a number of years. And for her role in creating Flickr, Fake was listed in Time Magazine's 100 most influential people in the world. And she had this quote here that I just think is a great starting point for the slides today. The most successful entrepreneurs I know are optimistic. It's part of the job description. And we've had a year, haven't we? The 2023, I would generally say, is not the most optimistic of all the years, especially in my tenure here, but we're going up. We're being optimistic. I have reason to be optimistic, and you all are entrepreneurs. So I figured you all should be optimistic about the year ahead as well. So let's go into this with a sense of optimism and look at our market update for February, our most recently completed month, and dive right into it, folks. Let's dive into closed sales for February. And I am going to bring up just a little note here before we dive into anything else. February closed sales is emblematic of a correction. Some of you may have heard me say this before, but there has been a correction going on for the past couple of years, and I bring up this red line here to show you what I mean. So let's follow that red line and just see, prior to the pandemic, there was a fairly I would say predictable pattern that was going on, right? We had the end of the month closed sales were somewhere between 25 to 2,800, slightly growing over the years, right? And then all of a sudden, a boom, 8%, 6% increases year over year, bringing us to a high of about 32, almost 3,300 for the month of February back in 2020, right? That was unprecedented in many ways, right? Yes, I do see, again, 2011, 2012, also a wonky year, but compared to the 5 years prior, abnormal, right? And then that abnormal activity in some ways has to be corrected for, right? That's what we're seeing in our most recent years, is being below this red line, which is fairly arbitrary, I will say, right? It's a visual cue here to show you that there's a correction point. So with that in mind, and in the spirit of optimism, like we were talking about, let's talk about that correction point, right? Yes, in previous years, we dropped down almost 19% to 2,300 homes closed in February of last year, and we are up 13% from that. We're still below where we were pre-pandemic for the month of February, right? But we're up from that low point from last year, right? almost 2,700 homes sold in February. And like I'm saying here, we are going to be returning back up to that equilibrium point, that point of stability, because correction is due. Pending sales, a similar story. I'm not going to bring out the dotted line for this one. Y'all get what I'm talking about. That there was a relative point of equilibrium, right? We had an abnormal increase in 2020, 2021, and a correction point. We finished February with 3,300 homes under contract. That's 13% increase from where we were last year. That's about for where we were 2018, little less than, right? That bubble, so to speak, is starting to become past. And hopefully, as we continue these webinars and keep looking at these charts, we'll be talking about the COVID-19 recession more in past tense and less in present tense, right? Let's flip the script here and talk about new listings, the supply side of this conversation. We ended February with 4,700 homes that were added to the marketplace. Those were our incoming supply of new listings. That's a 36% increase from where we were that same time of year in 2023. That's good. That means there are more people who want to put their home on the marketplace, and boy, do we need it, right? It is about where we were in 2020, 2021, but again, it's under very different market conditions, right? Not the low interest rate deal of the century incentives to go and sell your home. This is more of a longer term impact. And since we're talking about longer term impacts, I wanted to bring in a new slide here, not a new slide for us in general, but just a reminder of the market dynamics that we're talking about here. I think when we get into the weeds of supply, demand, we often attribute them as equal to each other in so many different ways, right? I even said it myself, flip side of the same coin, right? Uh, let's keep in mind what's driving the market here, right? This is a slide that David and I like to use. It's a great way to visualize things like the bubble of 2000, of the late 2000s, right? But we can view this in another way here. Red closed sales, that's your market demand. And I'm showing it here to show you that new listings, the supply of homes on the marketplace, is dependent on the buyer. The buyer drives motivation in the marketplace, right? And that's something we keenly are, we take it as fundamental, but it isn't necessarily front of mind when we talk about these charts. We talk about the dynamics with our clients. If somebody doesn't walk on the lot to buy, you're not selling, right? Case in point here, we have parallel lines here, roughly parallel lines in the late 80s, early 90s. Demand goes up, supply goes up, and then there's a correction, right? There's now a converging of these market forces here. And then what's happening in the middle? Diverging market forces. Demand goes down, but supply goes up. What did we call that? We called that the bubble, right? That bubble popped, and again, we had converging forces again. And now when we're looking at a more recent trend, looking at 2021, 2023, look how tightly aligned those market forces are, and they are in parallel with one another. We aren't creating a bubble for ourselves because new listings, i.e. the supply, the more intentional side of the market, right? The whole reason why we have a business is following the market trends, the more organic buyer demand, right? Keep that in mind from a big picture perspective. This is okay. Yes, it's tight, but this is a good thing that our supply is listening to our demand. to personify it in a way. Enough on that tangent. I hope it's insightful in its own right. Let's dive into another very important metric here, median sales price. Now, in February, we had a median sales price of closed transactions at around median of $358,000. That's up 4.5% from the year prior, but I want to talk about the year prior in particular because you can see that percentage increase was not as successful as what we had from 2023 to 2024, right? That is because, again, that equilibrium point that we're talking about was being corrected for in so many ways. Now, unlike the past charts we were talking about where the equilibrium point was relatively flat, this one is more like a straight diagonal, like a linear line, right? And you can see that we want that 7% increase. There's a little bit more variation here in February than it is in the year overall, but 11% increase and then 8% increase over that, that's your unsustainable market growth that we were seeing, that perpetuated run on inflation, even in quieter months like February, right? There was a correction for that between 2022 and 2023. We only increased about 0.5% in median sales price, right? That is that correction point. We're starting to get back on track with a 4.5% increase year over year from 1 February to the most recent in 2023. That's a good sign, right? So better way to visualize this is turning it into year over year change in median sales price. You can get a sense of what I'm looking at here in a more clear visual, right? We had, let's change to a little pen for you all to draw this out. Look in 2013, 2014. Look how the year over year change in median sales price. Look how high that was. That was over 10% in some areas. This is strong market growth. And you see how it's in the shape of a U? That's good. That's a sustainable practice, right? And you can see in the years in between 2014 to just short of 2020, we were right around 5 to 6%. Some peaks that recorrected, but generally right around 5 to 6%. Then we shot up like a rocket and then peaked relatively high, right? That's the unsustainable aspect of what we were seeing in the pandemic, right? And then when the interest rates started to go up, mortgage rates increased, buyers had less money to throw around, and then all of a sudden, median sales price corrected. We had a few months that we were just below, right? But now we are coming back out of it, 4.5% like we saw in the previous slide. Let's talk about percent of original list price received. Another idea of setting expectations of recorrection, right? We were in, prior to the pandemic, just short of 100% of what people listed is what they ended up closing on. And then again, this is at the median, half of all homes. In February alone, we're getting a little bit more, just a tiny bit more in 2021, and then we're getting about 1% over asking price in 2022. And then ever since then, we've hit a correction, right? We adjusted in 2023 to 97% of original list price, and then we're around 98% of original list price. That's good. That is a good sign to see that we are back to more of a negotiation plan that is expected with a pre-pandemic market. And I know there are some people, you've experienced this with your clients, the good old, yes, I know what all the comps say, but my house is special. I get it. I understand. If you sold a home back in 2021 and 2022, you definitely feel like you got the deal of a century, right? In some ways, by market terms, you probably did, right? It's about setting expectations with buyers now to make sure that they know that hey, your house can still be special. It's your home after all, right? But market forces are market forces. We need to make sure we're setting those expectations appropriately. Speaking of expectations, I never would have expected the speed of the market to be as fast as it was for the month of February in 2021 and 2022. I mean, 20 days, half of all homes sold in 20 days or fewer. I mean, that's impressive, right? And we have almost doubled that amount now that the Federal Reserve has imposed their regulations on the growth of the economy, right? We're now uh, in a February of 2024 where half of all homes sold in about 38 days, right? Now, it's still faster than where it was in 2023, and I would generally say that's a good thing. We didn't want this increase to keep going up too fast, right? This is a little bit of a check to understand that there's still strong demand in our marketplace. Um, 38 is a little bit more similar to what we saw in 2018, 2019, right? So we're getting back to a pace of the market that is similar to what we were seeing prior to the pandemic. And for those of you who have been here for a number of years, you might see that it's a familiar pace of what you were doing back, 4 or 5 years ago. But let's talk inventory, and something that definitely does need to increase is the availability of homes left active at the end of the month. What's the reserve supply, gas left in the gas tank, so to speak, at the end of a given month? And we finished the month of February with 6,800 homes on the MLS. That's 16% more than where we were last year, and that's still an increase of where we were in 2022, a record low for the past 2 decades, but it's still not close to where we need to be. I would wager we need to be closer to the 1300s, 1400s. And the reason why I say that is centered around the idea of month supply of inventory. We want to make sure that we have about 4 to 6 months supply of inventory. And as you can see between these two charts, they mirror the same thing, right? It's just a different way of looking at the same concept here, that we have strong seller leverage. Some might view that as a good thing, right? We want to make sure that there is a relative balance of buyers to sellers, because what were we talking about earlier on in this presentation, right? Buyers drive that motivation, that hunger in the marketplace. If there isn't someone there to buy, how long are you staying on the marketplace, right? How long is your home going to sit there if we don't have more buyers able to sell, able to go and buy, right? There is a balance here. We can't just always have our month supply of inventory down at around 1 month supply, right? But we are at about 1.8, almost 2 months supply of inventory. That's up 31% from last year. And we still have room to grow. And a big portion of that starts with development, encouraging development. But that is what I have for our standard monthly charts. And I know all of you love coming to this for the monthly charts. I want to make sure that I don't just give you the fish, I teach you how to fish. So I'm going to take just 30 seconds here and just talk about our web page. We actually just had a moment of trying to update this web page, and there will be some changes going into this in the year ahead. And I want to make sure that these tools are available to you now, so that way you don't forget about them when we do have website changes. Things like InfoSparks, creating your own charts and being able to share them with your clients, probably our most powerful tool. And I hope all of you on here are using that tool. Local market updates, a great little interactive map that gives you a monthly 1-page PDF breakdown of any way you want to slice and dice the Twin Cities metro. Our housing market sortable statistics takes the same data from InfoSparks and our local market updates and puts it in a quickly accessible, sortable list for you. So that way, if you want to pull up a number that you really need for your client quickly, it's right there. And then, of course, our daily showing activity charts that are within our weekly pulse, our Monday morning blog that we try to send out to you every week. All of that and more is available on our Minneapolis Area Realtors website. It can be found clicking on the market data circle right there, market data on the top of the banner. Please click on that, use it often. And if you ever have any questions, by all means, reach out to me and David. That contact button there at the webpage for market data goes directly to us. We're happy to answer any questions that you might have. So enough of my pitch for our cool tools. Let's dive into market segmentation. Starting off first with new construction, and it keeps increasing. Now, I will say, just as a preference for all these charts, we're talking usually about market share. What percentage of homes sold are new market in this, or new construction in this instance, right? And of that question, 14% of homes sold were new construction so far for 2024. This is, again, looking at an annual share. It's harder to do this month by month, but I figure the larger picture, this is good enough for you all. I went suddenly very fuzzy here, so we're going to hopefully reset. I'll come back into focus later, I promise. New construction, market share, 14%. That is up for 1, 2, 3 years in a row. And there was a bit of a glitch there for 2020 and 2021. Again, because of what was happening with run-on inflation, people were getting a deal of the century with previously owned homes, right? There was a wider berth. There are usually a lot more previously owned homes on the market than there are new construction. So that makes sense, right? Let's shift into townhouse and condo market share. And this one, man, if there is a metric for most stable market segmentation, I would give it to the townhouse condo market share. Yes, they've gone up and down a little bit, but just overall for the past decade or so, we're hovering somewhere between 23 and 27%. That is a point of stability that is heavily relied upon in some subsegments of this marketplace. If you're a townhouse, condo, seller, or buyer, that's a good stable marketplace to be in. Now, we keep watching this in different areas to make sure we're aware of emerging opportunities, maybe second or third ring suburbs, for instance. We keep a note of these to make sure that you guys are aware of them. If you have any or more questions around that sort of stuff, take a look at our blogs. We try to dive in deep with some of that stuff. More beds, please. This came out of the pandemic when we saw that there was a sudden increase in the desire for larger homes. In this case, the percentage of all sales that are 4+ bedrooms in the Twin Cities. And you can see we were hovering somewhere around 39% of all homes sold within a given year were that large. And then, boom, boosted up to 42%. And that has been slightly decreasing ever since. I think in time, we're going to get back to where we were in the 2015, 16, 17, 18 range. But the question is, how long? How long will it take for us to whittle down? And yes, it isn't the biggest percentage increase from 39 to 42%, but it's the fact that it happened so quickly, and it seems to have a little bit of staying power. It's interesting to see that there is there's a litmus test there within 2019 to 2020, and it might have some room to stay. Let's talk about the great mean reversion. This is another oldie but a goodie that we like to talk about when it comes to pricing and expectation here in the Twin Cities. Now, we go back far with this data, all the way to 1960. And we're looking at average sales price this time, not median sales price. And we have set some bounds here. Think of this as anticipated appreciation of home value over time, right? An upper bound of this would be around 5.8%, maybe 6-ish, and a lower bound here is 5.4. And we were exceeding that upper bound for a number of years in terms of average sales price. People's home values were increasing greater than what that bound was predicting. And then you can see that market crash. And in fact, David put in some handy little labels for you. You can see the 2005 to 2006 bubble and the 2008 to 2009 crash right here. And I want to draw your attention to the right side of that line chart, because we were recovering in 2010s, but we had an inventory shortage like David has labeled here, right? It was only until 2020 and 2022 with those, again, unprecedented year-over-year increases in sales price that brought us back into the bound, right? And then with low inventory and higher rates, we ended up correcting just a little bit. We're at the lower end of that bound. And again, this is average, keep in mind, not median, average of 434,000, 435,000 for the average home in the Twin Cities, right? Let's talk financing. The next few slides are going to be less complicated than this, but I wanted to show you this to start off. I'm getting really bothered by me being a fuzzy person, so hopefully that, there we go. So share of home financing types by year. And God, there's so much you can learn about our MLS data and the home financing types, right? But let's talk about conventional, FHA, and cash. Simplify it a little bit. I know there are a lot more options than this, right? But in terms of FHA, that's that kind of medium blue here. We had a decrease ever since we started recovering from the last recession, and it has increased a little bit, but nowhere near what we were seeing in 2009, 2010 with a third of all homes under FHA financing, right? A little bit of growth, but it's nothing abnormal. Now, conventional, looking at conventional, and that has ballooned for the past decade to be the predominant standard, right? Now let's take a look at cash. Cash had an increase. It definitely did to 23% in 2011, 2012-ish, and it decreased all up until when? Beginning of the COVID pandemic and that recession, right? Where all of a sudden we started seeing an increase of cash offers and cash sales. So let's get the messiness out of here and let's take a look at cash sales alone. Here's the same chart, a little bit more updated for you all, cash sales. And you can see the variability that we're showing here that's kind of hidden in that more blue, very complicated chart, right? Look at this. Look at, oh, I want my pen back. Look how steep this market share is. Again, this is market share. This isn't year-over-year increases, right? This is of the whole pie that is of sales. What percent of them is cash, right? And it has grown from 10% in 2020 to now 18% in 2024. My question is, when are we going to start to see the cusp of this increase? When are we going to start leveling off? Because right now, this is a pretty steep increase year over year. But it shows us here, looking at it at the market level, that cash is becoming more and more prevalent, where in 2011, 2012, it was cash and FHA and other forms of non-conventional financing, right? Conventional financing is still the standard here, but you're seeing cash increase. Keep that in mind as we get in throughout the year to see whether or not that 18% market share changes. And some of you might be thinking, okay, well, it's not necessarily, it could be one segment of the market. No, it's been increasing in single family, the blue line down at the bottom, up to 13%, townhomes to 23, almost 24% in orange, and condos 41%. Now, condos and townhomes, it makes sense. Lower price points, more likelihood for cash, right? But in single family homes in particular, and unfortunately I didn't think to put this chart in here, but David and I could both tell you that you're getting luxury market increases in the percentage of cash deals. Some of you already know that. Some of you, it's old news, right? But that is something to be aware of. We are seeing an increase in cash offers and cash closings in million plus for the marketplace still. All right, let's shift gears here and talk about the US housing market overall. I like to give you NAR's housing report that conveniently comes out the morning that we do each of these webinars. So I put in the numbers hot off the presses of Lawrence Yun and his research team to talk about February housing, both in terms of sales and in house price, right? Midwest down 3.7% for February compared to February of last year, right? Now that's the entire Midwest. We were up for February in the Twin Cities. So again, grass is a little greener on the Minneapolis and St. Paul Twin Cities metro side, right? The West overall is doing a little bit better with 1.2% down. Nationwide, we're down 3.3%. Housing prices, again, were up generally overall nationwide 5.7%. The Midwest up a little bit better, 6.8%, but we are not quite beating out the West being up 9.1%, nor are we beating out the Northeast with 11.5% increase from February of last year to February of this year. And I stress that the Northeast and the West because we're going to come back to that in a minute. Take a look at those numbers again and remember them because we are going to talk about them. But first, let's let Chief Economist Lawrence Yun have his piece. The main takeaway that he had in this month's report was additional housing supply is helping to satisfy market demand. He's seeing the same thing nationwide that we were seeing at the end of our monthly reports, right? That inventory is a little higher than it normally is because we see a bit decreased buyer demand. Now, he goes on to say that housing demand has been on a steady rise due to population growth and job growth. And in reality, the actual timing of purchases is more heavily determined by the mortgage rates and wider inventory choices, right? But those choices start with having more inventory to begin with. So more inventory is a good thing. He believes it. David and I believe it. We just need more of it overall in the long term, right? We'll finish things off here with about 10 minutes of talking about the wider economy. And then if you have any questions for me, think of them now, throw them in the chat, throw them in the Q&A. Happy to talk about them once we're done with this little segment. Now, David and I love to say this, right? Most agents know what's happening. Good agents understand what's happening. And great agents can explain what's happening. And really, that's the core of all of this, right? You all are here because you're good agents. You're probably great agents. We want to give you the tools to be those great agents that can explain what's happening in the economy. We all have the capability, the tools, the resources, and you have the support from us, the state and the national associations, as well as your broker. So let's lean into it. Let's spend time with this stuff. And now let's drive into some of the stuff that we're really interested in, right? Average 30-year mortgage in the past 12 months. And I am going to take my handy dandy little pen out again and say, for the start of the year, we've gone up marginally, a little bit. Yeah, we dropped. We definitely dropped from what, a height of 7.8% in November of 2023 down to 6.6%, but we've been slowly increasing our 30-year mortgage average. Again, this is nationwide for the past couple months here. Now, again, yes, we're low relative to what we were a couple months ago, but we do need to keep in mind that we are at a relative high point. You know, this going across. I'm not bad. I'm not too bad at drawing straight lines with this thing. Okay. What, 2007, 2008 was the last time prior to the recent past. So it's been a while, right? But we do know rates will go down slowly, and that's a good thing. But looking at the past year, right, we've been going up in the recent months, and that's something noted there. Now, keep in mind, the vast majority of Americans have experienced mortgage rates that are somewhere in the 2010 to 2022 range, right? In fact, we got a chart here to show it. The vast majority of Americans are outside this thin blue slice, right? They are from 5 to 6% all the way down to less than 3%. And that means that they are less likely to trade a 4% interest mortgage rate for a 6.9 that we just showed as a 30-year average, right? Some people, I'm sure, are getting this from their clients. I'm not paying 7% on a mortgage. And the response back can be, yeah, rent's 100%. It's David found this one. This is a good one. But let's talk about all of this in the context of recovery, because we've been talking a lot about curves and the shape of those curves and why that is important when we're trying to understand where things might go, right? Because if you're in the know, you might get a good guess of where things might go, right? I won't dive into recovery shapes of lines. We talked about this in a previous webinar, but just we want to take in the idea that different shaped recoveries have a different impact of what's going on in the Twin Cities, right? This can happen from as big picture as, inventory or supply of homes coming into the marketplace, like what I was drawing at the very beginning, right? Or could be as big as interest rates, right? And more appropriately, it's probably flip the whole visual upside down like I just did, right? Because that's really what we're talking about here when we're talking about the growth of the economy and run on inflation, right? Because this is what's leading in the news every single month when we talk about the economy. We talk about the consumer price index, and for some reason, getting it down to 2%, right? That here's the red line for you right here, and you can see we're stuck at about 3%. Here's a cleaner visual for you. Where we are is at the blue line, and we want to get to the yellow line. There is your curve, that recovery curve in the purple slide that we flipped over just a few moments ago, right? Where are we in this, and how are we going to get to that goal of getting to 2% consumer price index inflation, right? Well, The reality of it is our market has something to do with it. And why I mean our market, I mean our national residential real estate industry market has something to do with it. Same chart I was showing you before, right? But now I have added in the filter of looking at shelter. The US Bureau of Labor and Statistics calls residential real estate, whether it be home ownership, renting, what have you, as shelter. And that's that purple line that you're seeing here. Now, one of the contributing factors of the red line is the purple line. And the fact that the purple line has gone down, but is not quite going down as fast or as consistently as the red line, is part of the reason why we are stalled at around 3%. That shows me on the national level that there are some areas that are going to need to see more of the same of what we saw in 2023 in order for us to get to the goal of 2% CPI that the Federal Reserve is looking for. Now, I'm not necessarily saying us. Case-Shiller Home Price Index here is a great way to show that not all things are necessarily equal, right? And this is where I'm reminding us all of what Lawrence Yune's report just said this morning. Northeast up 11.5%, and the West is up in home price at around 9%. Meanwhile, we are at, what was it, 4.6%, half of what the West was regionally. Now I'm comparing apples to a whole bushel of apples here, right? But that has a bit of insight in it that I want to tease out for us all. Case-Shiller Home Price Index here, with Miami being at a relative all-time high. And then just below that, Los Angeles, Seattle, Tampa. These are all coastal areas who have not seen the same readjustment yet. They probably will at some point, but those home prices have to go down, or at least the rate of growth of those home prices have to go down in order for us to really get a handle on what's going on with our inflation, getting back to that 2%. And I will caution you all with saying we're painting with large brush strokes here, right? So keep this in mind as we're talking very broad ideas. This is not monetary policy at the Federal Reserve level guidance here. This is trying to understand the basics of what we are going through, right? Now, what is one of the major factors of a market increasing or decreasing in terms of demand? It's where people are moving, right? And you can see that this is already happening at a national scale. When Americans can afford to move, they consider their cost of living. And you can see that some of the pieces of information that I'm teasing out of here can be perfectly visualized in this map from the United States Census Bureau. This is showing a percentage change in state population from 2022 to 2023. They haven't gotten to July of 2024 yet, so can't show you this year. Hasn't happened. But at least in the last 18 months, you can see that we're seeing percentage increases in more relatively rural areas. Now, they might be picking cities in these states, right? But you're seeing California, New York, places like Pennsylvania, Illinois, they're having net decreases in their percentage change in population. And areas like the Midwest, the rural Northeast, the South, and the West are seeing those increases. Less populated areas are seeing those states increase, i.e., people are searching for a lower cost of living, in addition to many other things. But that's one of the things they are considering. And as an area that has a lower cost of living, may I bring you back to the Case-Shiller Index? We are in pink here. We're below the home price index for the US average here in the blue that I just marked with an X, we have reason to be optimistic here. People are gonna be moving here as opposed to potentially Chicago, for instance. Let's talk about why, right? Historically low rates and rising incomes had partially offset price gains, right? We've shown you this chart before, and we've brought in a line showing you that people are making a big deal. Oh, that was a horrible line. I'm sorry, everybody. You don't deserve that. You deserve better. Let's try for better, okay? Okay, we have this area between the red line that I crudely drew and the curve of the blue line where people were getting a monthly price that they were really succeeding on. Now this in particular, just to make sure for those who didn't see this before, this is the median family's earned income as and what are they spending for a median home at some assumed 10% down, 1.2% tax rate, 0.5% of insurance, and the appropriate 30-year fixed mortgage rate, right? And you can see they were getting a heck of a deal. And then all of a sudden there was that correction back up to at the middle of last year at about $2,700. And we are now coming down a little bit to $2,500 per month for the median family of that median priced home. But here's the kicker. Here's the thing that I want to make sure that we're all paying attention to. Let's put that monthly payment in the context of cost of living, the whole point we're talking about here. Same chart, same information. We're now putting it as a percentage of their family income. And you can see we never once hit around 30%. The same cannot be said for New York. The same cannot be said for California. The same cannot be said for Chicago. And that is the point that I'm getting at here. The percentage of median household income spent on mortgage payments is a desirable factor here. And so we have even more optimism. Nationwide, the context that we're all set in is a good indicator. And when I say that some housing markets are going to need to continue to compromise in order for us to get through with this run on inflation, get back to 2%, it may not necessarily be us first. It may be some of the more darker blue states that you see in this particular map, right? They're the ones that are still seeing high cost of living, and that is what the Federal Reserve is looking at. Speaking of, a quick transition out of this CPI conversation and just more about general optimism and emerging markets for you, let's take a look at the median age of home buyers, right? Now, this is something that I want to impress upon all of us, right? That the median age of home buyers has been going up, but it's been going up more in the past couple of years faster than it has in previous years, right? You can see here what I'm particularly interested in is the first-time home buyers median age at the very bottom of this chart. 36, 35 as a median, right? Now, where decades prior, it was around 32, even in the 80s, 29, right? But generally 30, 31 prior to the pandemic, right? Now, that has a lot of cause for concern for a lot of people, right? That people, particularly millennials, are struggling to become first-time home buyers, right? And that shows in recent polling. Apartmentslist.com did this polling to asking millennials, why do you expect to always rent? This connotation is coming out. The number one thing has been for a while, I cannot afford to buy a home. That was the same in 2018 as it was in 2022 when their most recent survey came out. But you can see that answer is the only one that has grown over time. Now, back in 2018, the idea of flexibility in renting was preferred, yeah, that's gone down since in the past couple years. So has avoiding home maintenances and other unanticipated costs. And buying a home sounds financially risky. That's gone down in perception, right? These are all perceptions of what home owning should be, right? But the biggest thing is millennials or first time home buyers in general feel like they can't afford to buy a home, which is why you get this connotation, whether it's in your social media or in the news, of them just saying, come on, collapse already. The reality of it is there is nothing to collapse. Think of the last bubble that we had in 2006, 2007, right? We showed that as one of our first slides, right? There was a diverging path between the demand that was going down and the supply that was going up. That was your bubble. Like we showed in the beginning of this presentation, those two market forces are pretty closely aligned and they're going in the same direction. There is no bubble that's going to pop here, right? There is going to be a softening of buyer activity, which we're seeing, but now we're starting to be more optimistic. And this is my challenge to you all is talk to those potential first-time homeowners. Talk to those people in the groups of 30 through 40 who have not yet purchased a home because they are one of the largest demographics. They are as large, if not larger, than the baby boomer population is right now, right? Uh, and that is an emerging market that has the ability to buy and should be optimistic about the next couple of years as this NAR forecast shows, right? This was at the end, no, it was mid 2023. So they forecasted throughout 2023 to show that existing home sales would hit the bottom of 2023 and then go up 13% in 2024. And again, it's not just NAR that's saying this. This is Fannie Mae, MBA, and NAR are all saying that as opposed to 2023 in gray here, that home sales forecasts are either going to be level or up. So there will be more homes that will be sold. There will be more demand. The market is going to rebound. That correction is going to happen. And with it, home prices. Home prices are going to increase. Um, again, we want that to be a stable, sustainable increase, but they will come back in time because there will be more demand out there. So this is the prime opportunity for those first-time home owners or soon to be first-time homeowners to not be disillusioned with this idea that they can't afford a home right now. There are opportunities available for them that will allow them to be first time homeowners. And that is our challenge, right? As realtors, to make sure that they have someone like you to give them the knowledge and the expertise to be competitive in this marketplace. Now, I am out of time, 2 minutes over. I'm happy to stay on for questions. Before I do, I just want to pitch Realtor Summit one last time, April 11th, Minneapolis Marriott Northwest. Please go and register. I can put that link in the chat one more time for everybody. But if you have any questions, happy to answer them now. I'll stop sharing and I will share the link and give you all time to type anything either into the chat or into the Q&A question. All right. There is the link to everyone to sign up for Summit. Does anybody have any questions for me? All right, just a quick reset of my camera here. I got a thank you from Katie. Well, thank you, Katie. I really appreciate it. All right, everybody. Thank you all for attending. You will all get slides and a recording of this video once it's posted on YouTube, as well as the link to the next webinar. It is going to be same time of the month. Look forward to seeing you then. Bye, everybody.